Are you retired or nearing retirement and wondering whether you're taking the right amount of risk in your portfolio? If so, stay tuned to this week's episode of the Retirement Income Source, where it's all about the income. Welcome to the Retirement Income Source, where it's all about the income. I'm David Scranton, here with my good friend and co-host, Sarah Samuels. And today, we are talking about risk, which happens to be Sarah's middle name, by the way. Are you taking too much risk in your portfolio if you're retired or approaching retirement, or maybe not quite enough? That is exactly the topic that we're going to explore today. So, Sarah, how's life treating you?
Well, it hasn't been too risky lately, Dave. I haven't been, taking too much risk lately. But how's your life going, Dave? It's great to be here, of course, with you and with all of our listeners out there. And thanks for joining a Retirement Income Source show.
Yeah, it's hey, as a pilot, I guess I take risk when I fly.
You're a risky guy too, Dave.
But I'm a pretty conservative pilot, though, right?
Well, you're a very good pilot, I'd say. But I've never been with you when I've heard the stories of some of the things you've done in your plane, though, when you've been up with your instructor and doing some crazy maneuvers.
That's how you learn. So you learn that way with the instructor in the airplane. But yeah, Sarah, this whole concept of risk is something that I think is important because people get numb to it when the markets have done well for so long. And really, we haven't had a really bad downturn in the markets for a while. I mean, yes, we had, when the pandemic first hit, we had a major downturn. I think the markets dropped 38% to be thereabouts in the spring of 2020. But with all the federal and government stimulus, everything came right back again. So as a result, people get a little numb to it, and they a lot of people are taking too much risk. But then, of course, there are some people that are just plain afraid and aren't taking enough risk and therefore not getting enough return.
I think that's part of the problem, Dave, is that a lot of people become complacent. It's natural when things are going well to really just, hey, things are going to continue to go well. But like you mentioned, it can catch you unaware, especially if you have too much risk and you're not prepared for it. So, Dave, can you explain what are the different types of risks that people need to be on the lookout for?
Well, there are lots of risks. People say there's risk relative to inflation, purchasing power risk, and other risks. But I'm going to look at just the most tangible risks when it comes to actual losses in investments. And there are really two types. One is called volatility risk. If you're diversified in a portfolio, then unless, literally our country completely fails financially and the world fails financially, you're not going to lose all your money, in which case you're more worried about volatility, the fact the value of investments can go up and can go down, and how long might they stay underwater. But if you're not diversified, then you have what's called specific risk. For example, if you have a lot of money in one stock, then you're taking a risk that, okay, I might, I could lose all my money if that stock goes belly up. Or even if you're, let's say, in the Magnificent Seven today, right? The old FANG, where you're in the 7 tech stocks, you might say, well, I'm somewhat diversified. Okay, maybe you are, but here's the reality. The reality is that the tech sector can go out of favor and go out of favor for many, many years. So you still are taking a lot of specific risk. How much do you need to have to be diversified? Well, generally speaking, you need to have at least 20 or 30 different holdings. That means stocks if you're in the stock market, and diversified across all the sectors.
Sort of like common sense, right? You never want to have too many eggs in one basket. But let's get to our Ask Dave question. We have our first question from Angela in North Carolina. She says, I'm a few years away from retiring. How much risk should I be taking?
Angela, great question. And we couldn't have started off the show for me any better than that, because it's based upon a bunch of factors that we're going to be covering today. One factor is, okay, how much money do you need in retirement and want in retirement for income, and how much money do you have, right? If you've oversaved and you have a lot more than you need, where you can generate way more income than you want in retirement, then maybe you can afford to take a little bit more risk if if you have the risk tolerance for it. Now, what if you haven't? What if you just have enough to get by? Well, then you may not want to take very much risk at all, because if you just have enough to get by in retirement, then if anything goes wrong economically, financially, then you might be forced back to work. So part of it has to do with your current financial situation relative to your goals. But Angela, there's a second part of it, and that's the emotions, right? It's whether or not how you're going to react when there's a loss. And that's the hard part, because you see, you may have had major losses in your portfolio in the early 2000s. 2002 and 3 when the tech bubble burst, and again 2007-8 when the financial crisis hit. But the problem is, back then you were working. You're still working, but I mean, you were working, you were younger, you're putting money away. It's possible the amount of money you're putting away in your 401k every month was making up for those losses. So you didn't realize how bad it was. And frankly, it feels different from when you're working and you don't need that pile of money versus when you retire and you do need that pile of money. So stay with us for the rest of the show, because we're going to talk more about some of those personal, emotional reasons about how you feel about risk. So one is the left brain quantitative side, but the other one is the right brain, more subjective, personal side regarding your risk tolerance.
Angela, thank you so much for sending in your Ask Dave question. And if any of our listeners have a question that you would like to ask Dave, all you have to do is send us an email to askdave@Retirement Income Source. That's SOURCE.com. And you're listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with Dave Scranton. And if you're thinking maybe you might have become too complacent since the markets have been doing well, barring the blip we had with the pandemic, if you're worried about complacency, if you think you might be taking too much risk, well, that is the topic of today's show. So far we've covered a few different types of risk, including volatility risk and the other type, which is really when you're not diversified in assets. And Dave, you mentioned that someone might think, hey, I'm invested across this sector, all of these different stocks, but really you could still have that volatility risk amongst the sectors.
Now, it's important to understand that, a lot of wealth has been created because people have a lot of money in one company. For example, there's a guy that owns a plumbing company right near where I live in Connecticut. Great guy. But he early on put a chunk of money in Apple.
Right.
And it just took off.
Yeah.
And he's made so much money off it. And he's made a lot of money having a successful business, but also he's made a lot of money off that. And he took a lot of risk. But for every story like that, there are 10 stories where people lost it all. So to some degree, when you take that type of risk, yes, you can make great amounts of wealth, but it's also dangerous. It's like taking all the money you have to gamble in the casino on a Friday night and going right to the roulette table and saying, I'm going to put it on number 5.
Yep.
Well,
you could win it all, right? You could. Who knows how many times you could you can increase your money, but you could lose it all too.
You can get 30-something to 1, or you can lose it all and then be sitting there, on the sidelines watching for the rest of the night.
Right.
and that's exactly what happens when you take that kind of risk. So, again, what is diversification? Well, diversification, depending upon whom you speak with, is designed to be anywhere from 20 to 30 different holdings. And it gets a mathematical function. So there's diminishing returns as you have more and more holdings. So the idea is, if you get over 30 holdings, then you're pretty much as diversified as if you had 500. And that's why the Dow Jones Industrial Average, Sarah, which has 30 stocks, tends to track the S&P 500, kind of sort of, which has 500 stocks, right? So that's kind of a little anecdotal evidence that, hey, when you get up to 30 diversified holdings, you're about as diversified as if you had 500, okay? But they've got to be across the sectors. And remember, there are 10 different sectors. So it's not just enough to have 5 technology stocks and 5 financials. You've got to be reasonably diversified within that market. And it's said that the specific risk that you take with not being diversified over the long run doesn't pay off. Okay, it's a gamble. It doesn't pay off. Just like going to the casino. Over the long run, you're going to lose more than you're going to win. But the extra volatility risk that you take when you're being diversified, but in a riskier class of assets, that's where you get paid. You get paid for taking that volatility risk. So again, we're going to be talking about this a lot more coming up. Good risk versus bad risk, and how you can know for sure whether you're taking the right amount of risk for your personality and for your stage of life. I'm David Scranton here with Sarah Samuels, and this is the Retirement Income Source, where it's all about the income.
Welcome back to the Retirement Income Source, where it's all about income. I'm Sarah Samuels here with Dave Scranton, and we're talking all about risk, and not the kind of risks you might be thinking when you drive too fast or go bungee jumping, but a really important type of risk, and that's within your portfolio. So far, we've talked a little bit about the 2 major types, which is volatility risk and not diversifying your assets, the risk from that. But Dave, you mentioned there's good risk and there's bad risk. So let's talk more about those 2 different types of risks.
Well, it's like, you have good cholesterol, bad cholesterol, right?
That's
Good
right.
risk and bad risk. And although I mentioned my good friend Chucky from my hometown in Connecticut, who owns the plumbing company, he took the bad risk because he put a lot of money in one stock, but he got lucky. He got lucky and
Well,
it
he
paid off.
invested in Apple, right? So it
That's
turned
right.
out well for
and he
him.
also did it at a young enough age when if he lost it all, it wasn't a big deal. It wasn't all the money he had, right? So he was smart about it, and it paid off. But if my guess would be if Chucky had chosen 9 other companies at close to startup phase, it's very possible that he might have had 9 zeros to go with this big this big gain. In fact, that's why even venture capital companies that lend money to startups, invest money in startups, venture capital companies, they go around, they try to make the best call, but ultimately they'll be in 10, 20 different startups because they know maybe 1 out of 10 is going to do really well, 2, 3 out of 10 may survive and do okay, and 6, 7 out of 10 might just downright fail. So that's the problem, with taking that specific risk and having too much money in one company. And that's why it's said in our industry, Sarah, that you don't get paid consistently for taking that specific risk. But what if you're diversified? So what if your risk now is not so much permanent loss, it's more or less just volatility? Well, that is risk for which you do get paid. So Sarah, when you hear this, risk, the more risk I take, the more return I get, people may not realize it, but what they're talking about is volatility risk. That all assumes that you are diversified. Great example, stocks versus bonds, right? We all know that you take more risk in stocks than you do in bonds, but if you're diversified, over time, you're going to get more return in the stock market than you are in the bond market, right?
Well, that's true, Dave, but we do know that bonds do have some risk associated, like what happened back in 2022.
2022, the bond index was down about 13%. That's correct. But that's because, but even then you were diversified, right? The stock market could be down a lot more than that. And I would say 2022 is about the worst you're going to see with the bond market, barring a black swan event. I mean, to see a 13% loss in the bond market in a year is pretty significant. But again, if you weren't diversified, it could have been worse. There were some bonds that were down 30%, right? So even though bonds overall are less volatile, i.e. more conservative than the stock market, you still don't want to be taking that specific risk in the bond market. You still want to be diversified amongst many different bonds or bond-like instruments for sure.
Right, that makes sense. You never want to have all of your eggs in one basket, whether it's with stocks or with bonds, even though they traditionally aren't as risky when it comes to volatility. So, Dave, let's get into our Ask Dave questions. We have a question here from Tyler in Ohio. He says, I'm diversified, but still, what's really a realistic worst-case loss on paper?
All right, Tyler. Well, you're diversified. I'm not sure what diversified means. So I've got to give you a couple of different answers here. So first of all, if you have all bonds and you're diversified in the bond market, as I mentioned, I think a reasonable loss is probably what we saw back in 2022. Let's call it 15%. Let's round up, right? That's a reasonable loss if you're diversified in the bond market. Now, obviously, if you were in all long-term bonds in 2022, which the index is not all long-term, it's a mix. If you were in all long-term bonds, you might have been down 30%, right? It could be a lot worse. Shorter-term bonds, a little bit less, and the ag being more balanced is where you get that 13, 15%. But what if you were in the stock market, Tyler? Well, then I would say you could lose as much as 50%, 50, if you're diversified. And again, if you're all NASDAQ, more tech-laden, then you could lose more. But if you're diversified, let's say like the S&P 500, the answer I would give is 50%. Now, why is that? Because beginning in the year 2000, when the tech bubble started to burst, it lost 49% at its bottom in the fall of 2002 and the spring of 2003, nearly 50%. Then it barely recovered in 2007, the financial crisis hit, and then it dropped more than 50%. I believe the number is 53. So let me ask you, Tyler, if it happened once so far this century, in fact, twice so far this century, it tells us it can what? Well, although I can't hear you, I know what you're thinking. You're thinking it tells us it can happen again. And of course, that is the answer. So, Tyler, if you're in the stock market and you're not in NASDAQ, you've got to be, thinking 50%. If you're in NASDAQ, more tech-laden, well, then you got to go back to 2000 and say, how much did the NASDAQ lose? And, the answer is it lost, 75%. So it could lose that much. Now, let's say you're diversified in S&P type stocks and you have some bonds. Well, then it's going to be some blend between the 50% and the 15%, depending upon your own personal allocation. So, Tyler, I hope that helps.
Tyler, thank you so much for sending in your Ask Dave question. And if any of our listeners or our YouTube viewers have a question, maybe about retirement, maybe about risk in particular, and you would like Dave to answer it, all you have to do is send us an email to askdave@retirementincomesource.com. And thank you for listening to the Retirement Income Source, where it's all about income. I'm Sarah Samuels here with Dave Scranton, and we are talking about different risky behavior, especially when it comes to investing. So if you're the kind of person who wants to invest in all one type of asset or in all one type of sector, you might have some potential issues. And Dave, you just answered a really great question from Tyler out in Ohio. And he mentioned that he's diversified, but what's really a worst case loss? And you said that even in the stock market, looking at the S&P 500, a 50% could be worse. In the NASDAQ, it could be even more than that, even up to 75% loss.
Yeah. And people need to realize that the market was underwater for essentially 13 years because when it barely got back momentarily in 2007, it took another shellacking with the financial crisis. And, when you're working and the market's underwater for 13 years, it's a good thing because you're plowing more money in to your 401k, your IRAs, you're buying more shares when the market's down. It's a good thing, actually. It may not feel good when you see your statement going down every month, but it's a good thing because you're loading that spring, and when the market finally recovers, now you've got more dollars in it, you recover faster and to a greater extent. But the issue is that you've got to be careful, because if you're retired, it could be 13 years underwater. Again, Sarah, the fact that it happened once tells us it can what?
It's probably going to happen again.
Or at least it can happen again, right?
It could happen again.
So now you retire, at age 65, and the market goes against you, and it takes till age 78 to get all your money back. Well, you got to, you got to think about our listeners here, right? How many go-go years do you have if you're retiring in your 60s, right? If you're lucky, you have maybe 15 go-go years. And if you're taking too much risk, then you essentially are sacrificing all the things you want to do, all the reasons you retired in the first place, maybe for 100% of your remaining go-go years in retirement. So that's why, Sarah, I say you have to really be careful about, okay, how much have you saved? We talk a lot about how you can get 5% income, right, today if you know how to get income from your portfolio. So you have to say, okay, this is how much money I have. This is how much income I want to generate. Do I need to get 5% or no? If I can get 5% on half that dollar amount and still be okay, then maybe you can afford to take more risk mathematically, at least, from a logical left brain standpoint. But if you say, nah, I need to get at least 4%, well, then you got to be careful how much risk you're taking.
Right.
Because you're simply not, you might be able to lose a little bit, but you certainly can't be 100% in the stock market.
Right.
So that's why everybody's got to really take some time in the years leading up to retirement. This is why people wait so long to plan for retirement. It makes me nuts, right? Because you have to get ahead of it to say, okay, how much money do I have? How's it growing? Where might I be at retirement? And how much am I going to want for income? And then how much risk I should be taking, right? And people just are complacent now because of what's happened in the markets. The market's been good for the last several years. They've seen things go up more than go down, so they don't worry about it. And they should really be looking at this starting 10 years before retirement.
Yeah. You don't want to get complacent. You don't want to gamble with your retirement. But Dave, you touched on something very interesting, which is the math behind how much risk is too much risk for you. And I think this is a difficult question to answer for a blanket approach, but when it comes to each person, it's really an emotional thing. It's really a psychological thing. They need to think for themselves and really feel, think about how it will feel to potentially lose that much money. So in just a few minutes, I want to talk more about the math behind it and how you can figure out how much risk is too much risk for you, plus the emotions behind actually seeing that loss. I'm Sarah Samuels here with Dave Scranton, and you're listening to the Retirement Income Source, where it's all about income. Welcome back to the Retirement Income Source, where it's all about income. I'm Sarah Samuels here with Dave Scranton, and we are talking today about risk, particularly risk you might be taking inside of your portfolio. So we've talked a little bit about two different types of risk, volatility risk, as well as not diversifying your assets, Dave. And we've also talked about good risk and bad risk. So we've really covered the logical part of risk and risk taking. And we know why some people want to gamble. It can be fun when it pays out, but when you're gambling with your retirement money, you're taking a huge risk there.
That's right. Especially if you're taking that, that specific risk that comes from being not sufficiently diversified, because that's been proven over the long run. If you take enough of those risks, you won't get paid for taking that. You won't get extra returns for taking that. Just like if you stay in the casino long enough, the odds are stacked against you, right? There's a reason they say the house always wins. So that's great when you're younger with a little bit of your money if you really want to take a flyer. Heck, I even put a little bit of money in Bitcoin, even though I don't believe in Bitcoin, just because, well, what if I'm wrong? It takes a flyer. Why not? It's a little bit. If I lose it, it's no big deal, right? But generally, if you're going to take a risk being retired or within 10 years of retirement, you want it to be that volatility risk, that you're diversified. And now the risk isn't, gee, will I lose it all? It's just how big are the swings going to be? And that is the good risk. So, Sarah, I think it's important, again, it's a pet peeve of mine that people don't plan early enough. And really, 10 years before retirement, you should start looking at it and saying, how close am I right now to having enough money to generate the income I want in retirement? Which means you have to go through the process of figuring out how much income you want in retirement, right? And then, okay, how close am I? And then if I keep saving money and reinvesting conservatively, am I likely to get there? And how much wiggle room will I have? Again, if you're barely going to get there, then you've got to start to be careful about how much risk you take. Because if you take too much, you might have to work 13 years longer than you wanted. Why? Because, again, at the beginning of the century, the stock market was underwater for most of 13 years. And one more time, Sarah, if it happened once, it tells us it can what?
Could happen again.
It could happen again. That's right. So that's why starting that early is so important to get ready to assess, am I going to be way ahead? Am I going to be barely there, or am I going to be behind? Now, if you're too far behind, then you might say, well, I'm just going to stay 100% in the market. I'm going to roll the dice, maybe not even dividend stocks, and hope for the best because I can't retire when I want to anyway. I'm behind. Okay, and that's okay because you're taking the good risk. You're not taking the specific risk, right? You're still diversified. But if you have enough points to win the game, if you know that you're going to be right about in that range, then, it's time to focus on defense a little bit, not just offense. There's a reason why when sports teams are winning and they get toward the end of the game, the focus is more on defense, right? Just don't have any turnovers, don't have any errors, play good defense, run out the clock.
Right,
and
just protect the points that you have. Don't worry about scoring anymore.
That's right.
Yeah. Well, I really want to encourage our listeners to, if you're thinking about how can I learn more about income, I'm worried about my risk. I think if it sounds maybe a little complicated to take on yourself, go check out retirementincomesource.com. We have a map there where you can actually find an income specialist in your area and take Dave's advice, do it earlier rather than later. So let's get into our Ask Dave question. We have Caroline from Florida. She says, I'm retired and I am invested for income, and all my income is actually coming from dividends. So do I really need to worry about a paper loss?
Wow, that's a great... Who's this again?
This is Carolyn in Florida.
Carolyn? All right, Carolyn. Well, that's a great question. And so you understand the left-brained argument. You understand that, okay, as long as I'm not selling principal, as long as I'm taking interest in dividends, then I shouldn't have to worry about volatility. That's mostly true. Now, caveat, the reason I say mostly is because companies can cut dividends, right? So if you're in the stock market, as you say, as opposed to having bonds and bond-like instruments that have a fixed interest payment, in the stock market, companies can cut dividends. But it doesn't, they don't like to. Companies are very hesitant to cut dividends. So if you're diversified, in theory, you should be okay. Now, if I'm relying only on dividends as opposed to some bond interest, I would want to have a buffer. So I would want to have at least a 20% buffer in income, more income than I need or want, just in case some companies do cut dividends. But let's say you have that, and we're not worried about cutting dividends to a point where, hey, you're not going to be able to do what you want in retirement. Well, now, Carolyn, it goes to really more the right brain side. And it goes to more of the emotions behind it. If you're a regular listener, you've heard me talk before about how more than a decade ago, probably about 13 years now, I was on Worth Avenue in Palm Beach. It's like the Rodeo Drive of Palm Beach. All the affluent people from Palm Beach proper, a lot of billionaires, decamillionaires, centimillionaires right there. They shop there. But on this particular Saturday, there was nobody there. Why? Because Bernie Madoff just hit the newspapers that basically the hedge fund had imploded and he had essentially stolen everyone's money. Now, these are some smart people, Carolyn. They didn't put all their money in Bernie Madoff's hedge fund, right? Maybe they put a third. But let's say they had $50 million and put a third of it into Bernie Madoff's fund. They still had $33 million left after Bernie Madoff failed. Well, the question is, if you have $33 million, do you have enough money to shop on Worth Avenue? Well, heck, I would think so, right? In fact, I bet these very same people, when their net worth was increasing and maybe they were only at $20 million, they shopped at Worth Avenue. Why? Because they felt good because their net worth was going up. But when their net worth was going down, they didn't feel good and they didn't want to spend the money they had. They couldn't even enjoy the money they have. So, Carolyn, the second part, now stay tuned to the show because the second part of this is now going to be about that emotional component, which I think is maybe the part that you haven't considered. But great question, Carolyn. Thank you.
Carolyn, thank you again for sending in your Ask Dave question. And if any of our listeners have a question about retirement, income, if you want to reach out to us, all you have to do is email us at askdave@Retirement Income Source. That's SOURCE.com. And thank you for spending your weekend here with us on Retirement Income Source, where it is all about the income. I'm Sarah Samuels here with Dave Scranton, and we are talking about risk, all of the different parts that go into taking risk. So, Dave, we talked a little bit about the good risk versus the bad risk, the logical part of risk, how it might be okay to take some gambles when you're younger and you're still working, but how when you've reached retirement age, when you're nearing retirement, it is not the time to be gambling. And Dave, we just answered a question from Carolyn that was really about the psychological aspect of risk, which is hard for a lot of people to empathize with, right, until it happens to them. Now, if you've lost a lot of money before, if you've seen that, then you understand how damaging that it can be.
Well, let me ask our listeners, and maybe they don't know because if they've lost a lot before, but they were still working, they weren't relying on that money. So it affects people emotionally different. Now, if you were working and you lost money and it affected you emotionally, well, then I'm just here to tell you it's going to affect you a lot worse when you're retired and you actually need to rely on that money. But think about these billionaires at Palm Beach proper. If they still had plenty of money left, but emotionally they didn't feel like spending their money, they couldn't enjoy the remaining money they had left, then I think you need to ask yourself, well, how's it going to affect me if I don't have the amount of wealth that these folks have?
Right. And the average person, they want to be able to, I think everyone actually in general, they want to enjoy their retirement. They don't want to be stressed out, especially during those go-go years you mentioned, Dave. That's the fun part of retirement. When you're going and traveling and visiting the grandkids, you don't want to be stressed out about the gambles you might be taking.
And for some people, they may have an old-fashioned traditional pension plan that pays them a great monthly income. Of course, they have Social Security, and they may not even be able to fully enjoy that income, even though they're not touching their investments. They not be able to enjoy that income because they saw their net worth just drop by a greater amount than they're comfortable with.
Right. Well, that's the thing. People want to feel comfortable. They want to feel, they've already gotten complacent with the markets doing well, especially people are invested in the markets, but they want to feel good about what they're doing. And that's important for spending money. No one's going to be out there spending money just like those folks on Worth Avenue. No one's going to be enjoying their retirement if they're sitting and worrying about their net worth and thinking how they don't have enough money.
That's right. And as smart as Carolyn is to say, hey, she must be a regular listener because she's living off the dividends and that's fine. But okay, so you're living off dividends, you're living off the interest, but still, how is it going to make you feel emotionally? So I always tell people, look, take a minute. I mean, sit there in silence and close your eyes and imagine you've given up your income, you're retired, your investments that's all there are. You're not going to be adding to them anymore. And all of a sudden you see them drop by 50%. Or 35%, or 20%, or 10%. Where's the pain point? Where's the pucker factor? And try to figure out where that number is where the pucker factor becomes too much. And if you can do that, then you can figure out with a lot of common sense what your allocation should be to suit your risk tolerance level.
Dave, this morning I was actually driving into our studio, and people were trying to merge and change lanes on the highway, and I noticed that almost every time they hit their brakes, and I thought about it.
Your pet peeve.
It's my pet peeve, right? But psychologically, I thought about people tend to really hit the brakes before they shift, before they make a change, because they're scared. And I think that really goes into risk too, and especially when it comes to retirement. So in just a few minutes, we'll talk about why stepping on the brake heading into retirement might not be the best move that you can make. I'm Sarah Samuels here with David Scranton, and you're listening to the Retirement Income Source, where it's all about income.
Welcome back to the Retirement Income Source, where it's all about the income. I'm David Scranton here with Sarah Samuels, and today we are talking about risk, specifically, as you might guess, investment risk, and how the parameters change when you approach retirement, and they really change when you are retired. So far we've covered the good risk versus the bad risk, right? The good risk being, okay, you're diversified, so your risk isn't really one of total loss, it's more one of volatility. Then we also covered how to figure out how to quantify from a left brain standpoint, okay, how much risk can you afford to take based upon how much money you have relative to your retirement income goals, and why you should start planning for that, frankly, 10 years before retirement, an ideal situation. And then got into the emotional side of it in terms of, okay, even if you are living off interest and dividends, how still losses can affect you emotionally where you can't even enjoy the remaining income that you have.
A big part of this is the human psychology, Dave. And I mentioned a few minutes ago when I was driving in, I noticed that people on the highway, they tend to hit the brakes before they change lanes, or even when they're merging on and off the highway, they hit the brakes, right? And I think it's because psychologically, people get nervous. They get scared when they're going to shift, when they're going to make a change. And I think that could be why a lot of our listeners might be struggling with making this shift that you mentioned.
And in general, Sarah, when it comes to making financial decisions, you should be rational. Things should be well thought through. So, having a little bit of ability to tap the brake isn't a bad thing. But, if you're closer to retirement than 10 years, especially if you're within 5 years, then you got to realize you're behind. When you are going through an intersection and you realize there's somebody coming that's about to broadside you, you don't have time to tap the brake and think about it. You got to step on the gas and get out of there, right? And if you're within 5 years of retirement, then you don't have time to tap the brake. You really need to step on the gas and make that change, because a change that you're going to make to lower your risk is only going to protect you. Now, if you step on the gas and take a breather after making that change and you say, well, maybe I overcompensated, you could always put a little bit more risk in there. But the problem is, if you tap the brake on making that risk reduction adjustment, then frankly, you end up in a situation where, you might, if that drop occurs, you might not be able to retire when you want. And as we said, the fact that the market's been underwater for 13 years, once in this century, one more time tells us, Sarah, it can what?
It could happen again.
Could happen again. That's right.
Yep. Well, too, Dave, you mentioned before about how retirement, it's almost like a football game, right? Once you've collected enough points, you really need to shift into the defensive mode versus if you don't have enough points, right? If you have not saved enough, you don't have enough money to retire, you really need to go into offense mode. So if you're looking for an income specialist, maybe you're 5 years out from retirement and you're concerned and you want to shift into high gear here and you need an income specialist to help you, you can check out our map of the U.S. with all of our income specialists across the country at retirementincomesource.com. Let's get into our Ask Dave question. So we have Joey from Minnesota, and Joey says, Dave, I'm invested in bonds, and I know that they're a contractual investment like you always say, but they can drop in value too. So wouldn't that affect my income?
Joey, great question, and that is a very common misnomer. So I'm glad you asked that, because I'm sure a lot of our listeners, Joey, feel the same way. But the reality of it is, bonds have a face amount because they're a loan, right? So when you lend money to a company by buying a bond, that company has to pay you back the full amount. And the interest is calculated based upon a percentage of that loan amount. So even though the market value of the bond drops, the income doesn't drop. So essentially, if the market value of the bond drops, now the percentage income appears to be actually higher, but really it's the dollar amount of the income that's guaranteed on a bond. So if it drops, that's not a concern. Now, when it does become a concern, Joey, is if it drops so much that the company's risk of defaulting on debt, then you might get in a situation where they stop paying interest, they can't pay back all the principal at the end of time, and that's an issue. But as far as your income's concerned, the same is true with preferreds, right? Preferreds are a class of stock, but they're much more bond-like than they are stock-like. They're bond-like because they have a par value, a face value. They're bond-like because they have a fixed dollar amount of income, not percentage, dollar amount. So if they drop in value, your income isn't affected. They tend to track the bond market more than the stock market. So why are they called a class of stock? Well, they're called a class of stock because they're perpetual. They go on forever. Unlike a bond, they don't have a maturity date, right? So it's a little riskier, but as far as your income's concerned, again, the dollar amount of your income is what's assured. And in that case, all you have to worry with bonds and preferreds is default, bankruptcy, right? And that's why you need to be diversified. As long as you're diversified and you've eliminated that specific risk, then your income is assured. It's not like common stocks where you can, companies can cut dividends. It doesn't work that way with bonds and preferreds. Again, accepting a catastrophic situation, i.e. a corporate bankruptcy.
Joey, thank you so much for sending in your Ask Dave question. And if any of our listeners have a question or maybe something that you've heard that you would like to get some clarification on, all you have to do is send us an email to askdave@retirementincomesource.com. And thank you for spending your time here with us on the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with Dave Scranton, and today we've covered all of the different types of risks as well as ways that you can avoid certain types, right? Like if you've diversified your assets, you can avoid part of that risk, but you still have to watch out for volatility risk. And Dave, we've talked about the logical part of risk, right? The part that makes sense when it comes to your logical side, but when it comes to your emotions, a lot of times people aren't as logical as they should be, right? And they're nervous to make different shifts, especially when it comes to retirement, because they're worried. It's different for them, right? Change is hard sometimes for people, especially as we get older.
Well, it reminds me of the story I talk about a lot on the show here, Sarah. My client, who's a big executive, his name was Ed, of a company in Connecticut, and he was retiring. He had millions of dollars, and his income needs were really conservative. But he wanted me early in my career to do a mathematical analysis proving that he'd never run out of money. And I said, well, you're just spending a fraction of your interest. You're a smart guy. I don't understand. And he said to me, Dave, you're right. You don't understand. When you are thinking about retirement, my entire life, I've been getting my paycheck, putting some away, spending the rest, and life has been great. I've never had to live off my savings anymore, and it's a complete paradigm shift, and it's nerve-wracking. So, I would say to you, if you're listening and you're thinking about the retirement shift and it's nerve-wracking, well, that just means you're normal. In fact, if you're not nervous about retirement, it means you're abnormal. It means you should be nervous, right? You have to have a healthy respect, right? I'm a pretty good pilot. I have thousands of hours, very familiar with my airplane. But I never want to get complacent in the airplane just because the last 1,000 flights I've taken have been successful. You always want to respect the fact that you're 30,000 feet in the air and something can go dramatically wrong. So again, if you're too confident going into retirement, I think you need to tap the brakes and say, okay, what am I missing? What should I be thinking of? A healthy fear is actually good.
Right. Yes. And you have to think, too, about the different parts of how much am I going to need in retirement versus how much do I already have? And you mentioned, Dave, that if you have enough money, like your friend, even if you have enough money, then you're good. You focus on the defense. And even that isn't enough for somebody like your friend who had enough money to just fully live off the interest versus someone that needs to catch up, that needs to focus more on the offensive instead of the defensive. So what would be your best advice for someone that is about 5 years away from retirement and they really feel like they need to catch up, but they don't want to take any unnecessary risk?
Well, that's a bit of a dilemma, yeah, because if you need to catch up where you think you're 5 years away from your desired retirement, but you can't retire, then you've got to say, okay, what can I do to hone down my retirement? I'm willing to work more years, first of all, to let money grow over time. Or second of all, if I'm not, then okay, can I hone down my retirement? Can I downsize? Maybe sell my house, get something smaller, move to a part of the country that's less expensive, and take those types of measures. And if you're simply not willing to work any longer, and you're not willing to downsize, well then, that's when people start to take more risk. But if you're going to do that, make sure it's the good risk, not the bad risk. And just realize that if it turns against you, even though you don't want to work longer, you might have to work longer because, again, you took that extra risk. The volatility turned against you, just like we talked about the first 13 years of the 21st century, right? Again, the fact that we were underwater for 13 years, Sarah,
Means
tells us it can what?
Again. It
can
happen again, right? And you don't want to be underwater, especially if those 13 years are the first 13 years of your retirement, the go-go years when you're supposed to be enjoying yourself. And we hope that you enjoyed this episode of Retirement Income Source. And if you want to listen to the show again or maybe send it to your friends and family, all you have to do is go to retirementincomesourceradio.com, and all of our past shows are there.
And most importantly, we hope that you join us next week right here, same time, same station. I'm David Scranton here with Sarah Samuels, and you're listening to the Retirement Income Source, where it's all about the income.